This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 21st. Some highlights from today's show. A key US recession indicators flashing red. UK inflation spikes much higher. And we cover some of the key S&P 500 technicals. Good day, traders, and welcome to the Daily Market Rundown. Let's get stuck straight into it. There is something very key going on again, very early doors in the European session, and it's all about yields. This is obviously now something that started last week. We, of course, did see some very, very big moves in some of the Japanese bond yields yesterday, and we've got that follow through today, and it now seems as though it's the UK that maybe started that with the very hot inflation print, and we're, of course, seeing as of right now the US 30-year is down 1% already, and it's very early in the European session. So it looks like it's going to be a very lively session. It's going to be all about yields. That is now the proxy market that everyone's paying attention to. We have got that US 30-year trading north of 5%. We, of course, also had mortgage rates in the US spike to yearly highs yesterday. So very much a concern for the US economy, and I suspect that's going to be the key theme for the rest of today's session. But that in mind, let's get across and talk about our first topic, and that's all about the spike. That's all about the spike in UK inflation. Now, again, it was expected to come out around 3.3%. It's actually come out around 3.5%, and that's kind of bamboozled all economists. But it really now does throw in this situation in which, the Bank of England would desperately like to cut. We've got a very weak, economy in UK. We, of course, did have a little bit of a good start to the year, but with inflation now starting to move higher and still well above that 2% target, it really does rule out rate cuts from the BOE. We, of course, also know that the tariff situation is not going away anytime soon, and so it just does look like a very dire situation for the UK. But I think what's important here is less about the actual news and more about the implications for markets, okay? The backdrop, the context that we need to understand. If we go back to sort of the beginning of April, we saw Liberation Day. As a result of Liberation Day, we saw bond yields all around the world spike up in terms of yield. Okay, the result is we've never given back that higher yield. Okay, if you go and have a look at any bond market, effectively yields in the long end are higher than where they were pre-Liberation Day. In other words, the market sent a clear signal that tariffs are going to be inflationary. Okay, now this matters because yes, fine, near-term equities have bounced, and near-term it feels like nothing can go wrong and there's no risk in terms of what goes on in the world. But the reality is that long-dated yields are always at risk. Okay, and the key thing to take away is that we did have a very big uptick now in inflation in the UK. There is a general line of thinking that we're going to see the same thing occur in the US. Everyone's talking about very hot inflation prints coming down the pipeline in the next couple of months, and that's why we're seeing not just the US curve steepen, but all bond market curves steepen. Okay, that has got implications for markets, whether you accept it or not. We will start to see those implications come through, and I suspect it starts not just yesterday with the BOJ. Now it follows through into the gilt curve, and I suspect we're going to see that follow through into the US curve, particularly with this big beautiful bill that is now going to be very not just fiscally irresponsible, but also investors are going to demand higher yields if the US is going to keep spending as the way they are now. There is the gilt curve. Two things to take away from this. We have broken out of that sort of 4 or 5 day range. One thing to point out, if you go look at Liberation Day, we were trading somewhere in and around that 465. So you can see we're around 10 basis points higher. And the key takeaway is, of course, that 481 now comes into view. I suspect we'll trade those yields today. And then if tomorrow you come in the European session, we're north of 481. Again, that's just going to be a follow-through theme. So if we do see a little bit of risk off today, this is the key. If you see a little bit of risk off today in the equities and you come in tomorrow, you can almost expect that yields are going to push again tomorrow, and that means you can expect to see a little bit of continuation in the risk off move in equities. In other words, you want to be short risk today and you want to hold that short risk over into tomorrow's European session, because the risk reward makes sense given bond yields in Europe are likely to be higher over the course of today, tomorrow, and into the end of the week. So that's the key look here. We get above 481, we are going to come into that 490, which is just, it's the highest 10-year yields we've seen in the UK for some period of time. Okay, so that is a key focus point for today. Now, very important is there is this thing going on in Japan, and it's very, very important that we understand the implications of this long term. Okay, at a fundamental level, don't forget for the last 30 years, Japanese bond investors, insurers, pension funds have not been investing in their own economy because the BOJ owns the bond market. Okay, moreover, insurers cannot or will not invest earning 0% yield, and so what they did was they all put their money into the United States of America. Why? Well, because you can borrow those money from pensioners in Japan, and effectively you can get 4% yield over in the United States with a very strong currency in terms of dollar against the yen. It was a fantastic play because you didn't even have to hedge the exposure. Okay, you would win in terms of yield, and of course you would win in terms of the currency long term. And that's what we can see on this chart. If you go back and you kind of look at the green line. The green line is the spread, okay? This is the spread between the United States and Japan. And you can see that if I just drew a sort of a straight line over time, since 2000, in fact, this goes all the way back to the 1980s, you can see very much that spread has been trending all the way from 4% all the way down to, call it 1%, okay? In other words, we have very much seen a situation where the US has just always offered significantly higher yields than ultimately Japan. And we can see that, of course, in the purple line, we've got US 10-year yields, and orange, we've got Japanese yields. And you can see they've just always outperformed, always, okay? Now, since, of course, 2020, of course, Japan was still not moving on rates. The US moved on rates quite quickly, but we can all of a sudden see since the beginning of 24 and, of course, this year, with the BOJ now starting to hike rates, as well as, of course, the Fed now, keeping rates where they are, we're starting to see that spread begin the process of narrowing again. Okay, now what does that mean? Well, ultimately, what that means is at a time now where we're starting to see spreads narrow and there is concern around the United States. In other words, there's concern that the US deficit is going to be problematic in the long run. The US dollar is going to be weakening. What we are starting to see, and we did already see last year, is these repatriation flows. Okay, now repatriation flows are not something that happen all of a sudden. They are something that's more strategic in nature. It's something you sort of think of in terms of we're going to do it over a period of 1, 2, 3, 5, 10-year horizon. So it's not, oh, we're just going to repatriate tomorrow. Okay, it's steady, and it's sort of a strategic maneuver rather than just a one-off kind of thing. So what that points to is this idea that we're seeing now where everyone's disinvesting in the US, or at least to a degree, perhaps diversifying out of the US into alternatives. I do expect we are going to see the same thing in Japan. Okay, given what's going on in particularly long-dated yields in Japan, it makes absolute sense for pension funds, for insurers to now start investing in their own damn bond market because they're getting very, very good yields, particularly in long bonds. Okay, I think 3.5%, 4%. So the key here now is I suspect we are going to see the spread continue to narrow in the JGBs versus 10-year, and as a result of that, we should see the currency start to appreciate as well. Now, for long-term traders, we all spoke about this head and shoulders yesterday, but I do expect that breaks at some point over the course of the next couple of days and weeks. So Japanese yen long against the dollar, I think is a fantastic play over the near to medium term. Okay, keep a very close eye on this because we've got a 20-year auction today, and I do expect that has got all the potential for fireworks. Okay, if we get any bit of weakness in that US auction, it does perhaps start to signal this idea that we are going to see insurers and pension funds in Japan perhaps start to focus a little bit more on their own bond market as opposed to ultimately the US bond market. Now, don't forget the two biggest owners or holders and buyers of treasuries are, of course, the Japanese and the Chinese. So keep a close eye on that. And again, it's no coincidence that we are seeing what's going on in terms of JGBs. It's no coincidence it's happening at a time during the ongoing tariff situation. Okay, so all of this has a lot to do with everything. It all has got to do with the same damn thing, which is some sort of political diplomacy going on in the background. So don't be surprised to see weakness in that auction today. And if we do get that, if we get any sort of hint of weakness in that 20-year auction today, okay, particularly with what the bonds are doing right now, we will see a spike in yields. We'll see that 30-year US bond move all the way north of 510. That is going to create a significant implication for US risk markets. Okay, think 3, 4, 5% down in the next couple of sessions, and we will again resume that downtrend that we saw from Liberation Day. Okay, now with that in mind, it's not all doom and gloom. What we can see, of course, in terms of the bonds, there is the grid. We can see, of course, 30-year yields down 0.7 in Japan. We can see 0.5% down 10-year yields in the UK, and we can see, of course, 30-year yields in the US down 0.9. So, and of course, even German bonds, the safe haven is down 0.5%. Right? It's not just the long end that's selling off; it's this aggressive steepening. And we'll talk a little bit about why that matters. But one thing to pay attention to, particularly over the next couple of sessions, keep an eye on what we call the Japanese grid or the Japanese crosses. Make sure you're aware of what the yen is doing against its major trading partners. Why? Well, because if you start to see that yen significantly strengthen, that will be pointing towards a situation where we're seeing these repatriation flows. Okay, so keep a close eye on that, because if we get repatriation flows, what you are going to see is more weakness in long bonds, and if you see more weakness in long bonds, that is going to translate into a very, very significant weakness in the risk markets. Okay, don't forget as well, like I said yesterday in the market rundown, the S&P 500, the Nasdaq, the Russell, they're all overbought in the near term. Okay, so they are due a very healthy correction. I think 5% is quite easily and quite expected. Don't forget as well, there are reports of record short hedge fund positions in US equities. We know Jamie Dimon was saying yesterday that this is really kind of a situation where investors are just being nonchalant about the risk in markets. So there are a number of people calling this recent move a little bit dramatic and overdone, and I do expect we're going to see that roll over. It did already start 2 days ago. Okay, we spoke a little bit about this yesterday with the Mag 7, and we'll get to that in a minute. Okay, there is the 30-year chart. As you can see, we're trading at the highest levels now. In some time, of course, if we close up, it will be the highest closed since 2023. Think about that, 30 years closing at the highest close since 2023. And like I said, the correlation with the SPY is going to correct. This SPY will reattach itself to these yields. They might be bouncing down. It might feel like a wonderful time in the SPY, but the reality is that that correlation will reassert itself. And like I said, bond yields are very sensitive now. We get above 510, all bets are off. We are going to make our way back down to that 500 level in the SPY pretty darn quick. Okay, and this then will of course be confirmed as a dead cat bounce. Now I'll talk a little bit about this in a moment, because we are going to be looking at this recession watch over the next couple of days and weeks. Now, one thing I did perhaps like 4 or 5 years ago was I actually did an analysis on the 2s10s, because this is very much a fantastic recession indicator, but it's important to understand how it works. Everyone talks about the 2s10s, and when it reinverts, it's a guaranteed recession and blah, blah, blah. Okay, the reality is the 2s10s inversion, or the steepening of the curve, can be led by two things. One, it can be led by growth. Okay, and the other thing it can be led by is inflationary pressures. Okay, now typically growth leads to inflationary pressures, or at least when you have strong growth and inflation, that's not necessarily a bad thing. Okay, the point is, this time, however, this steepening in the curve that we've seen over the course of particularly this year is being led by stagflationary concerns. In other words, higher inflation, lower growth. And that's the kind of steepener that puts the US economy into a recession, guaranteed. Okay, not 50%, not 60%, 100%. If we're going to continue to see inflation move higher, and we're going to continue to see growth move lower, it means the Fed cannot cut, and stagflation will all but make sure this curve steepens even more aggressively, and we will be in a recession. Okay, and this is the key thing to focus on. When we get very aggressive steepening, which we will get should we start to see failed auctions in the US, should we start to see US 30-year north of 510, we will start to see this thing very quickly steepen. And if you see that, you've got to be alert for the key recession indicator. Okay, when you get significant rate of change in terms of the 2s10s steepening, that is signaling an incoming recession, almost an instant recession. Why? Because it's ultimately signaling to us that longer dated yields, or at least financing conditions in the long end, are rising very aggressively. Okay, and what that means, if you think about it at a fiscal level, imagine you Scott Bessent looking at the 30-year today, you're going, well, 510, there's no way we can issue long duration. Okay, so it's a de facto tightening at a time when the US economy is very much needing some form of easing, but unfortunately the Fed cannot ease because of what inflation is doing. Okay, so keep a close eye on this. Now, what I want to show you is go and have a look at effectively the last two sort of recessions. If you go back to 2000, obviously this is covering it, yeah, but this is the year 2000, and it's very, very similar to what we have now. But you can see initially we got that steepening, and we sort of made a top prior to that steepening. Okay, but it was very, very gradual. I'll zoom into this for you in a minute, but it's this very aggressive rate of steepening that ultimately caused that 42, 45%. It was actually almost a 50% correction from high to low. Okay, 50% correction. You go to the next form of steepening. This was, of course, the 2008 financial crisis. Again, we very much topped out and did absolutely nothing for a good period of time as the curve started steepening. And it's when we got that very aggressive rate of steepening, that's when we got the very aggressive drop in 2008. And of course, that was also a 50% correction. Okay. Now, 2000, arguably, we never really inverted, but keep in mind this steepening post 2020, what was it driven by? It was driven ultimately by a very supportive fiscal response and monetary policy response. In other words, it was driven by higher growth expectations. Okay, and yes, we eventually got that higher inflation as well, but that's when, of course, they scaled back all the QE and the rate cuts. Now, we've got to look at, of course, 2023, 2024. We scaled above that zero line as we moved into that US election. And ever since that US election is somewhere around here, you can see we've been steepening quite dramatically. Moreover, and I'm going to zoom in this a little bit quickly. If we go look at the period now more recently, and I just sort of mark out November, it comes in somewhere around there. Okay, you can see post that Trump election, the curve has steepened almost 50 basis points. Now, 50 basis points of curve steepening between the 2s, 10s in its own is not a problem. Like I said, you need to see something like this. You need to see a rapid rate of change. That's what scares the shit out of the market. Okay. Now, I just want to go back one chart because I want to show you 2000 and how similar and eerily similar it looks to modern day. Think of the start of 2021. We got that initial steepening and then we flattened out and did nothing. We then got that next bout of steepening. Okay. Very, very similar. You can see the market topped out initially, a little bit of a double top. We sort of started to move a little bit lower, a little bit of corrective behavior, a nice steep bounce. Okay. We then ultimately got that breakout and we got that extension. Okay, we then moved sideways again. We ultimately balanced out. We then got that steepening again and we then collapsed, and then we kind of moved sideways and we steadily moved higher, and the bear market was ultimately confirmed. Okay, I just want to go back to modern day, but look how similar this is. Okay, obviously I haven't zoomed this all the way back, but we have got effectively that double top over there, 1, 2. We eventually had that sell-off as the curve steepened out a little bit, and we're now starting to move our way back towards those highs. Now, what I'm not saying is that this is going to suddenly dramatically roll over in a straight line. What I am saying is, if all of a sudden bonds start to move, if all of a sudden 30-year gets north of 510, if all of a sudden we see this move up to 80, 90, 100 basis points over the course of, this week, this month, next month, whatever it might be, it's that rate of change that's going to create that dramatic sell-off. And that's what I want you to be aware of. Watch for that rate of change. Of course, I will be pointing it out on the daily market rundown as well as the Discord channel. Okay. Now, just a quick note on the FANG, an update. This was yesterday, and you can see that again the FANG was leading. Now, don't forget, it's the FANG that drove this up, which is why we're so hell-bent on focusing on it. If FANG drove us up, if FANG is ultimately what took us to overbought, now that it's no longer being bought, now that we're seeing some forced profit taking, that ultimately is the signaling for a turning point in the market. Okay, NVIDIA down on the week, Apple down 2%, Tesla down, nothing dramatic. Don't forget, these markets have rallied a significant amount in the last couple of weeks, so these are not dramatic moves, they profit-taking moves. The point is, we saw profit-taking Monday, we saw profit-taking yesterday, and I suspect we're going to see some more profit-taking today. Okay, now that in mind, we do have the VIX expiry today of options, and so what that typically means is that sort of grindy kind of boring price action that we've seen for the last 3, 4, 5 sessions, that's going to go away. We should see the VIX open up a little bit today, so you should see ranges expand. Okay, so expect a little bit more volatility in the market, a little bit more free-flowing markets as a result, of course, that OPEX expiring at the cash open today. Now, one final chart just to focus on this is the rebasing chart because we need to know where to take aim. Okay, what you've got here is you've got NASDAQ in this nice light green, and then you've got the Russell in the soft blue, and of course the S&P in the purple. So what do I mean by where to take aim? Well, if we do roll over, you want to sell the weakest market, not the strongest market. Well, we can see since Liberation Day, everything sold off. We then got the initial bounce with everything. We then get the higher low, and then all of a sudden we started to see the tech industry take over when we got back to flat. Okay, so since the beginning of May, we can see how the NASDAQ is completely outperformed. NASDAQ is up 10% versus 5% in the S&P versus 4.5% in the Russell. Okay, in other words, it's tech that led the recovery. Surprise, surprise, Mag 7. Okay, that's why we're focusing on it. If Mag 7's weak, ultimately the rest of the indices are going to be very weak. And obviously, given what's going on in the rate situation, Russell is absolutely the one to take aim at. Okay, like I said, mortgage rates are now sitting at the highest levels they've been in some years, so that all of this just points to a situation in which Russell is a very, very decent short trade for the session. Okay, I've said a lot, I've gone through a lot, there's a lot going on. Let's summarize. pay attention to yields. It's as simple as that. Pay attention to the 2s10 and the steepening going on. Pay attention. The rate of change there is going to signal an imminent recession. Okay, don't forget record short hedge funds. Right, they're all short. Now, yes, we can argue that it's the retail market and the retail market is beating the hedge funds. The reality is the retail market will never beat the hedge funds. Okay, it's as simple as that. Now, that does not mean we cannot go bid today, but what it does mean is if yields push higher, okay, equities are going to struggle to rally. And don't forget, this is being the most hated short. It doesn't mean people have given up on the short. Okay, so keep an eye on yields. Ultimately, watch that VIX today with that expiry. I do suspect that's going to be a little bit higher. And then most importantly, watch that auction around 6 p.m. London time in the US. That 20-year auctions week, all bets are off. We are going to see a very, very aggressive retracement in the equity markets. Okay, that's a wrap. Any questions? Discord channel. Otherwise, good luck out there. Manage the risk. Go make some money.